the ultimate extraction platform continues to extract.
Andrei's throwing down the gauntlets. Andrei with the gauntlet thrown. I love it. I love it.
Nothing wrong with it, but call a spade.
The double dip, right?
Graham, I want to talk about how the markets are ripping. Actually, I think they're consolidating. No, wait, we're crashing. We're all going to die. It's mass mayhem.
Okay. We'll get into that. But first, a word from the sponsors that make this show possible. Welcome back to Bitcoin.com's Token Narratives, where we discuss the biggest stories shaping the Bitcoin and cryptoverse. My name is Graham Stone, and I'm repping the Bitcoin.com marketing function. I'm joined, as usual, by news and research gigabrain, Mr. David Sensel, and chief scientist, Andrei Terentiev. How you guys doing?
Pretty good.
Enjoying the latest Trump and Elon
beef outside
of the crypto sphere. Don't know if we'll touch on that at all, but it's been some good entertainment.
It's a wild thing. Not unsurprising though, right? Like two major egos who are very gifted at playing the meme public attention game.
Yeah.
Wasn't there a prediction market on this?
Probably.
Yeah. So there actually is. I'll probably find it somewhere. I'll find a link in a bit. Well, market obviously dumped today, but corresponding with that was the chance of the big beautiful bill, the BBB, passing. I think dropped from 75% to 50% or something like that. So maybe. In theory, that's less money being printed, causing markets to dump. Not sure.
Isn't this some misunderstanding of how the BBB works? Right, like it's technically not increasing any funding, right?
It's a little bit unclear to me personally, like who's correct in this situation. So they're obviously increasing the deficit, but are they spending more money? Who knows? Probably they are.
The interpretation that I saw was that it's disingenuous to say that it's creating more money in terms of they're creating more money, but they're reducing the rate at which more money is being created. So it's like
well, the way I understand it, it all hinges upon the GDP. If you can grow the GDP, then the bill can be considered less of a draw on the less of need to print, right? Less deficit spending.
Yeah, but also I think isn't it just like a net deceleration of so it's printing more, but it's not the rate at which that printing is decreasing, not increasing. I thought
that was
the
main thing is more okay, well, they increase the ceiling to 5 trillion or whatever. Whether technically they don't have to spend that much, but the reality is that it always ends up, well, we got to spend as much as we can to reach the ceiling. Even though technically that doesn't mean they would spend as much, but I don't know. To be seen.
All right. Well, Bitcoin obviously has a bit of a dip here, about 5% drop, possibly on this news. Wider equity markets also sold off to a lesser extent, I think. So I think the question here is this a buy the dip moment? What do you guys think?
Yeah, I mean, in general, I don't think anything has changed from what we've been saying for the past, I don't know, 3, 4, 5 months. Everything looks positive for Bitcoin. What's it called? Profligate spending in America and abroad is it seems to be in the cards, and this can only help Bitcoin. And I don't know, all the other macro backdrop indicators seem to be looking overall pretty good. So,
Can you explain this super signal thing?
Yeah. So, this is just a piece of hopium again. So if any of those people out there who talk about like, oh, cherry picking data, you can always get data that will confirm your bias. I know that this is one of those things where you can kind of look at find some kind of niche data that will confirm your biases. Yeah. But again, this is just that. So basically, this is just talking about how volume levels, when volume levels are very, very low in this metric, but the price isn't dropping to a certain degree. In the past, this has always happened just before a giant leg up, and so this is basically saying we're in this cherry picked data thing where the volume, they're saying volume threshold or whatever, is very, very low, and the price is kind of consolidated. And the 3 other times that this has happened, it's always been a very large leg up. 2013, 2017, and it kind of looks like earlier this year, I think in September, October, it happened, and here we are again. So this is more of a fun chart. I wouldn't put a lot of stock in it, but yeah, little hope.
I like it. Yeah, I saw the M2 global liquidity chart circulating again last week, where people were saying, "Look, it is predicting a dip as well," and I mean, it's like correlates so perfectly, the M2 money supply chart with the Bitcoin price, like 12 weeks behind. So that's kind of fun. But yeah, we do know that Bitcoin is highly correlated with M2 money supply. Go ahead, Andrei.
What's potentially bullish is like the way I think like a lot of people are afraid of like the micro strategy the strategy blow up. But I think it's going to take like a longer time for that bubble to percolate or like diffuse, right? Like it's not like these companies just can instantly acquire all of these Bitcoins. It's going to take them time. And I feel like that's kind of like the thing that could cause that spike that maybe you're talking about, David, in the super signal or something like that. But it's still like not there's no rush yet, I guess I would say. It's like everyone's doing the announcing, but are they doing the buying yet?
Yeah. So actually, on that note,
saying something? You're on mute.
Oh, sorry. Yeah. I was just going to agree with you, and it makes sense that kind of volume would be low, right? If you look at the mempool for Bitcoin, for example, it's very, very low, and I imagine transaction volume on exchanges for spot Bitcoin are probably pretty low, because it does seem like the marginal buyer of Bitcoin is just institutions, and they're not going to be transacting back and forth a lot. They'll just be having kind of big single or small bundles of orders, and that's it. I would just like to point out, Graham, just on the liquidity thing, Forward Guidance podcast, which is great, and they talked about how the Janet Yellen playbook is now being replicated in, I think, a lot of other major by a lot of other major central banks. And this is this if like, for example, Japan and the EU do this, it is a major like sugar rush injection of liquidity. And
I think to your point, Tyler, about how
Let's play this
the
clip.
acronym factory will always come guns blazing eventually is pretty interesting because so last week we talked about Japan, the Japan situation. So obviously the theme of the situation has been that, you know, the BOJ is doing QT at the same time that we've seen insurers that are unhedged and et cetera, and that whole thing start to struggle on the long end as well. And now what we're seeing is the acronym factory, the Yellen playbook is going global. So what happened is a few days ago, the Japan Ministry of Finance, so the Treasury of Japan, talked about tweaking composition of its bond issuance plan that could involve trimming issuance with super long debt and then tilting towards bills. And it's interesting because you see the same headline come from the United Kingdom, which talks about that their focus on shorter term borrowing as fiscal pressure mounts. So, you know, this is my, you know, I think, like, you know, it's been called activist treasury issuance, I guess, ATI, and some argue it to be like a version of QE, where as opposed to just taking duration out, which is QE, this is just taking it out from the auction. And yeah, you got the puppets playing it around, and here we are. Every country is running this banana republic approach. Tilted all the bills. Everybody loves short duration. Nobody wants long.
I love how none of them talk about fixing the actual problem. It's like,
yeah, it's just like,
wow, the bond yields are going crazy. I think we should fix it. I got the perfect solution.
Yeah, let's lower front end rates and issue all in the front.
Let's just Ponzify it further.
You know that's coming here. It's coming here. This is why the short bond trade is so hard, because you're basically on the opposite side of the trade as the politicians that will do anything to mess it up. So if you're short 30-year, you know, it sounds great. It looks great. I feel like you should make money on that. But with one headline, bam, you're toast. Because like they could say, I'm issuing all, you know, 5-year and under debt. And by the way, we're lowering rates to 1% tomorrow to finance the government. And it's off to the
And then you do have the turbocharged version, which is issue bills to buy long bonds, which is probably, you know, that's like an operation twist from the fiscal side of things, which is just fucking crazy to me.
I mean, it's all doing that.
No one. So I feel like that's the next step.
I don't know if
this is second derivative.
I don't know if I don't know if I mean, so they kind of go on, but I don't know if everyone understands exactly what's going on here. But Biden's admin, Yellen, she did this thing, which I think is kind of the first it's been done before in a major central bank. Basically, she changed the mix of sovereign bonds that America releases. So usually you have, if you look at like a risk curve, right here is like zero risk, and then you go further out, and maybe equity is pretty far out, and then as you go in, you get to bonds, and then the longer bonds are the most risky, and as you get closer to actual dollars, they become the least risky. So you have dollars because they're the actual dollar, and then you have like short-term bonds. This is why you see in different disclosures you have things like, oh, they hold cash and cash equivalents. The cash equivalents are short-dated bonds, like 3 months and things like that, 6 months, maybe 1 year. And the point is because they're so short-dated, the risk that something bad could happen, and then you're not able to convert them into dollars is lower, and so that's why they're less risky. And so. But usually when you issue debt, a central bank, most of the debt you issue is longer term, 10-year, 20-year, 30-year, and 80% is usually 80% long debt, 20% short-term debt. Again, institutions, pretty much anybody, they prefer short-term debt over long-term debt because it's way less risky. And so Yellen was struggling with debt problems because Biden's had been increased the deficit so much. So she switched that around. She switched the issuance from 20/80 short long to 80/20, right? And so suddenly all these banks and institutions were like, holy shit, we can get massive amounts of short-term debt, and so they gobbled it up. And so it's like a new lever that central banks can use. They were talking about this to kind of juke the system, to try to prod and poke people, institutions, to buy bonds. And yeah, so they're basically talking about now other central banks who are also kind of backed into a corner, like Japan, the UK. They might start doing this too. And what it caused in America was a massive sugar rush, where it was a brief injection of liquidity into the system. But it's kind of unsustainable, right? And so, yeah, I mean, if all these other countries start doing this too, then they went on further to talk about some other weird esoteric things that you could do, where you issue most of your debt short, right, 3-6 months, and then you use the money from issuing that debt to buy your own long-term debt, right? Which is just, you start to be like this ridiculous stuff. So anyway, the overall point though is that this would help global liquidity, at least in the short
Basically,
term.
in the end, like you can't actually finance anything, right? Because if all your debt is like 1 year, I don't know, if you have to build something that takes 5-10 years to get an ROI, it's like impossible, essentially, right? That's kind of the downfall of this.
And well, also it's kind of the point where, so like sugar or something, it works in the short term, right? Because people and institutions are going to naturally gravitate towards what is less risky, right? So you see this massive shift in the short term because it's less risky. But let's say all debt then becomes this short-term debt. Well, then that's the normal now. And so then it's not going to be as effective moving forward because that's the new normal. That's becomes where most of the risk is. And so you're not going to get a continual sugar high, right? Because you get this one-time benefit because you're moving from something that is more risky, right, long-term debt, to something that is less risky. And so you get this nice bump. But yeah,
I guess like, so basically, and then the long term, like let's say the long term bonds, like the rates, they can't adjust them because, like, in theory, I don't know, let's say the interest rate on the long terms should like double but that would just fuck over all the existing bonds, essentially. Is that kind of...
Yeah, look what's happened in the US is Besant has weaned us off Yellen's absolutely, I mean, just terrible policy, right? And the long end has suffered, right? Look how high the interest rate is. It's because it's like coming off a sugar high. You don't want to go back to more risky things, and you're gonna have to pay for it, right? So the premium, as in the interest rate, is going to go up for that. And in the 1-2 year time, as you readjust to, go ahead.
Just to clarify something here, the government can set the short-term interest rate, but they can't set the long-term interest rate, the long-term yield, right? That the latter is decided by the market. The former is decided by what? The Fed?
Well, they can. There's different ways to do it, and it's kind of a spectrum. So they could target any interest rate on any what's it called, any yield or time frame, like any bill, right? By, for example, they could start buying their own stuff, right? And that would kind of set the interest rate. So Japan does it. The US did it a little while ago. That's kind of activist, though. It's considered a big no-no because the government is kind of putting its thumb on the free market. It doesn't have to be just short term. They could also do that long term. But it's easier. Usually, it's easier for them to influence the short end of the curve because they they have all these facilities, and I think they were talking about this like Alphabet kind of what do they call them?
The acronym factory.
Acronym factories, all these programs, right? Like I don't know, like SOFR and all these kind of things, and that usually affects the short end, right? Where they're like, here, a bank can come, one of these big banks can come to the government and get lending directly from us, and it's this rate, right? And that becomes usually the lowest rate, right?
Right.
It's not going to go lower, and then
it's also going to be the duration. Like if it's 30 years, it's just going to be more market dependent because it's just like such a long duration. If it's like a 1 year bill or something, like the market can't swing it too much because exactly what you said, right? Like the duration is so low that somebody can come in and just be like, "Nope, we're going to do this now."
Most of the facilities are overnight, like the repo facility and stuff like that. So that's if you can imagine it, an overnight repo or something like that, that would be a 24-hour bill, right? So then the duration is 24 hours, right?
Okay, so to summarize this, it seems like these central banks around the world are engaging in some shenanigans to sort of kick the can down the road, so they don't have to have any financial austerity in their countries. They can just keep printing. What does this have to do with Bitcoin?
Well, it would introduce a lot of short-term liquidity into the system, right? As all this money gets put into the system, basically. So it would be because Bitcoin is sensitive to liquidity. Presumably, it would go up from this. Yeah.
All right. David's bullish.
Keep borrowing until the jig is up.
I mean, I think it's a terrible thing to do, and I've talked about this privately with a lot of people. Like Yellen doing this was absolutely awful, and for no reason. Like that's the other thing is during the Biden years, the economy wasn't suffering. There was no emergency. Like, why in the hell would you do this when there wasn't some kind of flashing red light indicator saying that the economy is about to go into a tailspin? She threw gasoline on an already raging fire. Oh God, it's insane. So again, just completely, just very, very bad.
All right, let's switch gears to the Bitcoin Treasury, the latest entrance in the Bitcoin corporate treasury game. We have a proposal here from a failing Spanish coffee chain which is their share price of this company since it went public in 2 years ago or so is down 99%. But they got this plan to allocate about
memecoin
$1 billion into
the days.
Exactly. So that's the pivot. Okay, that's what. And then we got the K-pop version. So K-Wave Media announcing that it's going to be adding Bitcoin to its balance sheet. This is a NASDAQ listed company.
Good Lord.
Domiciled in the Cayman Islands, but with operations in Korea. So it's a Korean company, but anyway, they're getting in on the game. So there you go. Two latest entrants. What do you think? It's going to end in tears?
I mean, yeah, I think we've been kind of signaling this for 2 months or something. I mean, because we talk about it all the time, and at first we were like, "Oh, this is great," and then we're like, "Okay, some more," and then I think about 3 weeks to a month ago, we're like, "It's a lot of these. This is this is quite a lot." I've been thinking about this, Graham, a lot, and I think this is something that it helps to be in the news for, is because we cover this so much, and you just feel like you're saying the same thing week in, week out. It does kind of, I think, send a signal in your brain like, hey, this now seems like something fishy is going on. Not fishy, but maybe it can be overdone.
I don't know how to describe it, but like I also get this like where you say a Reddit term like this like a late stage capitalism type thing where it's like these companies aren't going to grow. They know this, right? They're looking at this and it's like we are capped out on all our growth, but we still have to like deliver on shareholder demand. It's like we're totally out of ideas. Well, let's just buy Bitcoin. Yeah, like this is like weird for some of these. Like for instance, like that coffee one is like a perfect one. It's like we're not gonna do like 100x back to our previous share price by I don't know, changing the label or like changing the recipe or something like that. Like the only shot we've got is to like do something like Bitcoin, right? Because we can't like make a tech business or something.
Yeah.
But I do wonder like, do more companies just end up in this situation where it's like growth is now finite? What do you do? Like I feel like that kind of hasn't been answered like as a corporate question because like up until this point it's always been well you just keep growing. Now in like a fully globalized like industrialized world it's like well there's not really any more growth opportunities anymore and
That's interesting. Yeah,
Along
and
that line, oh, sorry, go ahead.
it just kind of ties into that whole idea with like people say Bitcoin is bad for the economy because it encourages people to not spend, to not engage in economic activity because the price of Bitcoin just keeps going up, right? So why would you, if you're holding Bitcoin, why would you engage in economic activity? Just hold your Bitcoin. Don't spend dollars, right? So you could actually you can actually look at this as kind of fitting in with that theory, like rather than this coffee company, rather than like figure out how to innovate. Yeah, they're just like, oh well, actually, it's just easier if we just hold this asset, right? So that's kind of interesting.
Yeah, exactly, Graham. So I was going to say, I heard on another podcast that they were talking about this, and they're all TradFi people, and they made this point, which is not the framework I usually think in, but it's totally true. It's like, where is the kind of how is this creating more efficiency or growth, right? All these companies who are just buying Bitcoin, this is not going to improve GDP. This is not going to we're not going to get any kind of multiplier in terms of making the economy more efficient or adding new value, So it's basically kind of what you said too. So it's
financial games, but it is telling that like that's what it's come to. As you say, like Andrei, it's like a late stage capitalism type thing. But just as it relates to the price of Bitcoin, and I think we've discussed this a few times. I don't think that all these companies getting into this game now it's not bad for the price of Bitcoin by any stretch of the imagination. It's good. It's going to make the price of Bitcoin go up. But what it's going to happen eventually is it's just going to create a reflexive. It's going to make a bigger drawdown once we do hit like peak fervor at the top, because I think as Standard Chartered noted in this other piece here. In the case of just let me bring this up again. Actually, it was sorry. Yeah, it was the example they give was Core Scientific, which was the second largest Bitcoin mining company. So they decided to employ basically this strategy, like a Bitcoin corporate, right? So rather they didn't sell their Bitcoin; they just kept it on the balance sheet. Yeah, and what happened in the end is that the price of Bitcoin went down, and they ended up having to sell their Bitcoin at a lower price than what they had accumulated at, and the company went bankrupt. So they became a forced seller. It contributed to further collapse at that time of the price of the price of Bitcoin went down further than it would have had to had they not done this because they're such a big holder. And you could see that happening at a large scale, like when someday in the future, I don't know when, these companies become forced sellers.
Yep.
I'll
100%.
I'll be getting out of the market before then though, so it's okay.
Yeah. Exactly. We'll be signaling the Pico top on this podcast.
That's right.
Keep watching.
So stay tuned. All right, let's get into the wrench attack debate. Or did you want to quickly bring up this? Oh yeah, let's talk about the new Bitcoin leverage play, which is from Horizon.
Yeah, I'm not trying to cast shade on them. I just saw this, and the product might be completely legit and not an issue, but it's just more of a narrative, a token narrative, if you will, about how all these different ways of putting up collateral to buy Bitcoin are really, really, really coming out right now, right? Like, again, with these Bitcoin Treasury things. So here we have a thing where basically, as far as I can understand, I spent a little time trying to figure it out to see if there's any kind of big hidden problems, but it seems relatively legit. But again, just the fact that there's all of this stuff happening now. Basically, this company will take a position on your house, right? So they'll become kind of like I don't know, like a secondary. Yeah, like, but also they don't really have any rights in terms of when you sell or how you sell your house or things like that, as far as I can tell. And in exchange for that, they'll give you the value that they take the position in Bitcoin. I mean, that's it. And so again, you start to see a lot of things like this. Again, this might be. It looks really, really legit, and this guy I follow is a great follow. Just like Sailor's strategy is very legit, but then so we have this new thing coming out about kind of leveraging the equity in your house. What if other companies start doing this too, right? And then you get this kind of, and that's that's when you start to get worried, right?
Could you imagine if a significant number of people actually did this? Like how much buy pressure there would be on Bitcoin? It'd be insane.
Before, right? Where it's like I'm selling my house to buy Bitcoin, and it's like it worked out for a few people, I guess. So.
Yeah. So again, not casting shade on this. I think this is probably pretty legit. I feel when the imitators step in and they're less reputable, then it's this is the kind of thing we're talking about.
Yeah, well, how could this fail? Like, I mean, doesn't it seem the way you described it? It seems like
goes down and you're homeless.
that's how it feels. Then you become a forced seller of Bitcoin because in order to pay for your new housing costs, because like Horizon then owns your house.
Yeah, you either lose your house or lose your Bitcoin.
So for this, it seems like the way that they're doing this is really like low margin. So I think they take part ownership, but it's kind of like they're secondary, or I don't know what the correct term is, but they take like a shadow ownership or part of your position in your house. And then they have no say, I think, when you sell the house or you pay back the Bitcoin, you pay back your portion of their position in your house. So you can do it whenever you want. There's no like LTV requirement. And so the basic thing is that company is betting on the fact that houses in America are going to rise. The price is going to rise, right? And so then they get some exposure to the real estate. You, the customer, are betting that the price of Bitcoin is going to rise higher than the fast of the price of your home equity. Yeah. But there's no margin call on at least on the way that this company is structuring it. So it seems super legit. The only downside is,
would you do this?
if I went into the details more, I think I would. I think here's the difference though, is that company gets to be incredibly selective about who they give these loans out to. So my guess is that they're going to like reject
I see.
a lot of people or most people, you know,
They only
if
if they think the value of your house is actually going to go up.
Yeah. If you're in like Detroit or whatever, they're like, yeah, pass on you, you know, something like that.
Yeah.
So yeah.
So
that's what I think.
So from Horizon's perspective, it's a way to get high quality exposure to high quality real estate assets.
Yes. Yeah. And they get to be selective. But again, again, I think this is legit. But you could see that someone else looks at this and sees that they're a success. And apparently Horizon's had like thousands of applicants already, and since that tweet went out. A less reputable version could go out where they do have some claim and there is some kind of margin call on the thing.
Exactly.
And that's where it gets hairy.
But yeah, very interesting to see these types of instruments coming out, and I think really encouraging. I saw even in Japan, which to me is very, I don't know, like a financial backwater compared to the US, especially as it relates to like crypto. They there's at least one company I know of now that will give you like a fiat loan, taking your Bitcoin as collateral.
Oh wow.
Yeah.
Very cool.
Which is tempting. All right, let's get into the wrench attack debate because, the wrench attacks, the $5 wrench attacks, that's where basically, you get like accosted and forced to hand over your crypto or Bitcoin crypto. And they have a wrench. That's the idea, right? So
no
these are on the rise.
Engineering needed.
These are on the rise. We've seen cases all over the world, especially France, which is just like crime-ridden hellscape at this point, it seems. But also in the US, Southeast Asia, there was one in Argentina. They got away. The guys got away with that one, it seems.
Thailand.
A Russian was, Thailand, exactly. So I think there's been some debate amongst us here at the Bitcoin.com crew. The question is, like, are the crypto rich actually more vulnerable from these types of physical attacks than just normal rich people? Does the fact that it's crypto, does that make these wealthy people more of a target? And David, what's your opinion on that?
Right. So, I mean, I think it does. And there are two main things that I think to point out. Number one, it's not necessarily a completely logical reason why. It's human nature, right? So first of all, people see that it's like tantalizing. Crypto is like holding $1,000 in front of someone's face. Now, most people aren't going to just like snatch it out of your hands and run away. But if you hold $1,000 in front of someone's face, on average, versus holding like a credit card that has $1,000, on average, holding that money will incite more people to cross that line and steal your money. And so whether it's really logically consistent or not, I think having that temptation that crypto presents makes it true for most people. And then the second part is with poor OPSEC, it absolutely is easier to get a hold of money in a non-recourse fashion with crypto. And so I think as we do on this show and in news, we kind of talk about this and say there's all these wrench attacks and try to educate people, then it'll be harder and harder to get this. But right now, I still think most people's OPSEC and their relationship with crypto is not very well educated. And so people just have their phone, right? These young people, and then they just have tens of thousands, if not hundreds of thousands of dollars sitting on their phone, right? And that is the equivalent of just walking around with all that money. And so that it is absolutely easier to just bonk someone on the head with a wrench and take their phone and say, give me your password, and then send it right away. You don't have to go into a bank or make a wire transfer or anything like that.
All right, fair point. Andrei, do you have any thoughts on this?
No, I mean, in general, I would say I 100% agree with that. I think it's like just the nature of transactions, right? So with like all of these bank or fiat transactions, there's some level of reversibility. So even if you come in with a wrench and are able to get somebody a transfer of like, I don't know, $1 million, like whatever, there is still like a chance that it doesn't clear. Somebody else is able to like halt it. Somebody else is able to do whatever to pause that, right? So if you're coming in with a wrench, if you think about your risk-adjusted return here, if I manage to get the crypto guy to send me the money, that money is like there. I mean, you have to do a lot of stuff afterwards, but you have a 100% chance of being able to like keep the money. Whereas if you do it within any like banking format, you might, what is like 80, 70, 50%. So in general, you're just going to be much more enticed to go after that. On the OPSEC side, it's same thing, right? Like, I don't know how many people are like keeping all of their funds on one phone or one wallet or like whatever. My guess is probably like most, like 98%, 95%. Like most people can't be messed around to do this all split up and things like that. And to a certain degree, I think that's where like some of the exchange actually helps people, where it's like you kind of end up getting some of these safeguards of like, okay, some of my funds are on there and then I can get flagged. Like, you have different risks, but being on exchange actually does help de-risk the wrench attack compared to just like having it on your phone or whatever. Obviously, the best stuff is to have it split across multiple devices, multiple keys, but I don't know how. But even then, like, you might, if you have that much to where it's like, okay, I've got enough money that is split against so many keys, that still might be just a very enticing target, even if it's only a portion for any attacker. But yeah, so it definitely makes it more dangerous overall.
Okay, so I think everyone agrees that the crypto rich are more exposed to physical attacks in order to get their money than just like if you're traditional TradFi rich. Okay, so what can people do actually to protect themselves?
Hold on, can I just amend that a little bit? I think there is a point though that so for example, if you take the very crypto rich, 100 millionaires, billionaires, to me there would be no difference between like kidnapping them than another 100 millionaire or billionaire. I think that, to me, that those guys are definitely gonna have like, I mean, presumably have really good OPSEC, and I think the risks for them are pretty much the same as another 100 millionaire or billionaire. So this is for like the not super rich, right? Like the KOL that has $100,000 or $1 million or something like that. Yeah, it's
All right. So for someone who has a moderate crypto holdings, what should they do to prevent a $5 wrench attack? Obviously, the first thing is don't just go like walking around the bar like, whoa, Bitcoin tips, everyone. Probably don't do that.
Yeah, don't show your phone like, woo, Bitcoin just broke all-time high. Shots for everybody.
Yeah. Actually saw a video of someone doing that at a bar in London not too long ago.
Seriously?
The all-time, yeah. He got removed from the bar just for being a crypto bro, I think, basically.
Man,
people were just like,
England not going to make it, man. Not going to make
all right.
it.
So there's some interesting solutions out there, right? Like some technical solutions, right? I've heard about, for example, You can have like a like a kill switch. So where you put in a certain pin to your device when you unlock your device, like the under duress pin code or something, and that just sends all the assets in your device to like some other address that you don't immediately have control over. Like it's like controlled by someone else.
That is
Right.
That's a baller way to do it. I don't think if I was under duress and getting my fingernails pulled out, I would do that. There's the
Yeah,
the
cut me up.
finesse. Yeah, like it's gone now. I don't have any control of it. I guarantee you. Woo! Let's go, buddy. This is.
So the
not-
other solution, right, is you give them a little taste, right? And you're like, oh,
yes,
that's all I
exactly.
got, right?
That's the finesse. The finesse version is you have another pin code where you press it and then they get like 20% or 30% or something like that. And then you're like, oh, this is all I got, man. This is it. I put my pin in everything. And so then
Let
they
me
see
keep the
that.
rest of my fingers.
Yeah. You're like, I promise, dude, I don't have anything else. I'm pissing my pants, please.
You probably have to let one finger go before you give up that code, though, just to sell it.
Yeah.
Make it,
you gotta sell it, man. Dude, this is scary stuff. But yeah, so that's kind of the one I would recommend. Now, again, here we are talking about this is bad OPSEC, talking about the security, but that's probably the one I'd recommend. The other one is just you have crypto on your person, right? You have a wallet, like your hot wallet, basically your wallet, your Pump.fun wallet on your phone or your laptop, and it has whatever 5%, whatever you think is worthy to have on something so mobile, and then you keep the majority of your funds at your home, and so then it becomes a lot harder for a wrench attack. I mean, they do this, they kidnap people, but then it's like a normal thing. Then they have to ransom, they have to get a hold of your loved ones and do all that kind of rigmarole. But when they take you, you can honestly. Like, don't cut my finger. I gave you everything. That's it. I don't have access to anything else, and you just don't have it, And so,
yeah.
And I think in that case, that lowers the threshold of people who really want to go through with this whole like ransom thing, and that becomes more like a normal, the normal bar for kidnapping,
Yeah.
which is quite high. You don't see it very often.
Yeah, going on with I think just like investing in the multiple devices is like super valuable. If you have like $1 million of crypto, like buying another iPhone for $1,000, that is like your crypto phone is a pretty
Keep it at home.
valid investment. Yeah, right. Like pretty valid investment. Where your crypto wallets are on your this phone, and you do your shitcoin if you really like shitcoining on Phantom Wallet or whatever. You can
Exactly.
you can still do it. Just keep that one at home. So I think that's also a pretty valid strategy.
And to add to that, the phone that you keep at home, have all your 2FA for all the things on that one too, right? Like, so your exchange 2FA and all that, it stays on the same thing. So then even if you get taken, they've got your laptop, they've got your phone. You can't even log into your exchange because you don't have the 2FA, right? It's at your house with that kind of stuff. So I think that's, to me, like the bare minimum. What I would.
By the way, quick shout out to the French and Moroccan authorities, because they apparently did track down the guys, like this kidnapping ring. The head of it, perhaps, in Morocco.
Yeah,
as pointed out by one of our producers of the show here.
Yeah. Also, I'd like to point out that that same producer. So the whole reason that this became an internal debate within the company is the same producer was talking about this rising risk. I mean, and it basically was like, he was basically saying, like, what should I do? What's the kind of ethical thing to do in terms of like covering people in the space that accept crypto or deal with crypto, right? Are you then making them more vulnerable to wrench attacks, And so, shout out to him for bringing this up because
well, his question was interesting, though, right? Because he asked, like, what should local businesses do? Like, if you put a "We accept crypto" sign at your store, does that make you a target? So, like, my inclination is like, yes, it does, but eventually. It'll get to a point where people realize, the attackers realize that, oh, okay, like every business, they only keep a small amount, just like a bank only keeps a tiny amount of cash on hand, or like a liquor store keeps a tiny amount of cash on hand.
They've had a solution for that a long time in America. Guns.
Exactly. Yeah.
Yeah, but also all these cash businesses, all these cash businesses, they also, as crime increased, they had other solutions. But let's say, like in big signs, we don't carry bills. It goes into like a kill box that we don't have access to. So
exactly.
I mean, it'll be like
the same
that.
sort of thing will happen in crypto if the P2P use case actually ever does catch on.
Now, not to bring up anything, but Graham, you also had an overwhelming. I think your initial point is valid, but also a little sad, which was like, just don't live in a country with lots of crime, right? That's the number one. That's the number one thing to avoid.
It's a crime problem.
It's a crime
more
problem
than it is a crypto problem. So, yeah, maybe avoid France for the time being.
Yeah. Shout out to all the French people watching, but I mean, it's sad, right? It is. I think the baseline, it is sad. Like this kind of thing is probably not going to happen. Knock on wood, in Japan and whatnot. So yeah, move to a safe country.
Let's move on to. We got time, I think, for one more topic. Let's either do the Hyperliquid debate or the Pump.fun topic.
Right,
someone in the chat is asking, can you talk about pre-sale and platform legitimacy? That seems like a
Pump.fun, right?
Tangential to the Pump.fun thing.
Yeah, we could do that then.
Yeah, the Hyperliquid, is it better for an exchange to be like open and transparent, i.e. decentralized, or have closed like dark pool order books? I don't know, whatever, man. It's just like trader shit. Like,
I love it. Graham's take on this this quintessential crypto debate about transparency versus centralization versus decentralization. I don't know. It's just trader shit.
Come on, man. I'm just a retail trader out here.
Come on, man. Number go up,
That's
bro.
No. Seems like something for whales, right?
To be fair, Graham, as this whole debate was unfolding, we can move off of this because I agree. But I mean, I agree to a point. I was like having to do research as I was reading their answers. These like 3,000 word answers. Like, oh, God damn it. I have to read this and then use ChatGPT to ask him, like, is this what he meant? And, so, yeah.
All right. So what's happening with Pump.fun? They're going to do an ICO. Or maybe.
Well, we don't know. Yeah. So the rumor is that Pump.fun is planning to raise $1 billion through a token sale, and this will give their project company a $4 billion valuation. Again, these are anonymous or community tips, and so we don't know the details. Pump.fun has neither confirmed or denied this. And supposedly there's a 10% airdrop in this somewhere. So 10% just off the bat, that seems really low for this. And I don't know. Right. Should I just go through some of the positive and negatives, or should we just start talking about it right away?
Well,
the ultimate extraction platform continues to extract.
There, Andrei's throwing down the gauntlet. Andre with the gauntlet thrown. I love it.
Nothing wrong with it, but call it
the double dip, right? That's the.
Hasu was talking about this. Like, again, none of the details are out now, but Is it a double dip, as in they're making a buttload of revenue off of the platform from basically everybody loses, and they're making mad money, 200 million, and then now they're selling a token on top of that. Right? So like, what's the deal? So that's the one take, the double dip. And then why raise so much money? $1 billion. They're raising $1 billion.
Yeah, like, how do you need so much money?
Buy
Like,
Bitcoin.
Yeah, what the hell are they doing? Yeah, they're going to become a treasury company?
Yeah.
You can see that. Isn't that the EOS playbook? I heard that on the timeline. Like they're going to become like EOS, right? Like which just basically became an ETH treasury company.
Yeah. They did well.
So,
they did quite well.
So what's the Steelman case?
Yeah.
What's the Steelman case?
Well, so you had a lot of Solana people, right? Because this is a Solana project. You had a lot of like Solana defenders who kind of took up the Pump.fun mantle in defense of Pump.fun, and it's basically like what I'm not gonna do. I'm gonna do it straight. The basic case is that Pump.fun is one of the most successful companies in crypto, right? They've got proven revenue. They've got lasting interest. They're a successful application that drives volume and makes money. Why shouldn't they raise money to build an even bigger, better business?
Yeah, that's valid. But of course, it all hinges on whether the token actually accrues value from the project itself, or i.e., does the token kind of represent equity in the project? Because if it actually does, revenue, then if it actually does sort of represent some form of like equity in the company, then that's good, because it means everyone can get a piece of Pump.fun, not just the Pump.fun insiders, like the people who started the platform. But I would
just 90%.
I'd be surprised if there's any meaningful like accrual to the token, right? It's just, it's a governance token, like as usual, right? Like, because there's still no regulatory clarity, and then why would they just give away equity in their company?
Yeah, if I would agree with you 100%, Graham. Their past does not predict a good kind of net win for the people who buy the token, right? Like, I think it was Suzu or Lucas was talking about a month ago, Pump.fun started this new like creator incentive, I think, where creators of tokens got 50% of the revenue split for tokens that graduate from Pump. And then if you read the details, they just created a 50% bigger fee to the end user. So they didn't cut into their own fee at all. They just tacked on a 50% increase. So they announced this like, look, now our coin creators get 50% of the revenue. And then you look at the details like, oh no, you're just taxing the user 50% more. Congratulations.
Yeah.
So I don't know. I things like that. And also for things that don't graduate, which is like 80 to 90% of all coins never graduate, it's 5%. They get a 5%. The people who create 80 to 90% of all the coins, the split is 95%, 5%. So
yeah, the whole Pump.fun defense has kind of soured me recently on Solana, in the sense of like, just call a spade, guys. But you see like all these like kind of like big Solana guys jump through so many hoops to be like, oh, this is really good. It's a great thing. It's like, okay, like, sure. So the platform was originally meant to be like this raising tool to like get around VCs and stuff, but it's now just a meme coin farm. I don't know if I buy this narrative, guys. Like, it's like the hoops are just too much for me.
Yeah.
At least the ETH boys, they stand by their little purity, virtue signaling stuff.
Yeah.
I mean,
I wonder if,
I was just going to say, we don't know if, again, they could announce that like Hyperliquid, which sends 97.5% of the revenue goes straight to the buying Hyperliquid, which is crazy. That's really, really good. it could do something like that. But Andre, to your point, all of these big Solana accounts were already preemptively predicting that this wouldn't happen. They're like, well, come on. Nobody can be Hyperliquid Jesus God like this. I mean, you can't. We're capitalists, right? Like, we can only have one Hyperliquid. You can't do that. That's not normal, right? Like, so
it's weird.
Yeah. So one of the hopes
really
of
weird.
Yeah, one of the hopes of like Hyperliquid's success was that it would inspire other projects to take a similar approach, but doesn't appear to be the case. Of course, this whole Pump.fun thing, it's all speculative. Like, who knows? It's rumors. My inclination would be that it's like rumors seeded by the Pump.fun crew to see what the like reaction would be, and then maybe they readjust based on the reaction.
Ooh, interesting.
So
interesting.
They come out with this thing. Oh, they didn't. People were like, oh, the community seems okay with that. Yeah, let's do that then.
What does Solana have
to test the waters?
Pump.fun?
Well, I mean, quite a few of the apps on like the dexes on Solana are in like the top 10, top 20 fees by daily fees generated. Like,
or are they just trading
of all the apps in the
tokens?
Yeah,
yes.
I think it's mostly meme coins, right? That they're trading.
Yeah. So, I mean, there is growing DeFi on Solana, just like the same sort of products you have on Ethereum. But
this conversation is convincing me I made a mistake by buying Solana at the top. The meme coin frenzy is over.
Yeah. Yeah. All right. Last chance. Go ahead, David.
Yeah, I just wanted to say it was really interesting, this Pump.fun thing where so you had Solana people, we've already talked about this, kind of defending Pump.fun. You had a lot of ETH people obviously tearing it down. And then you had KOLs in the middle. And it was so funny to see the KOLs who were kind of trashing it a little bit, but at the same time they were trying to position themselves so that they could get an allocation in the and the funding round and or airdrop. And it was just you really got to see kind of all the sides, the major sides of crypto Twitter kind of involved in this, where so it was quite entertaining, I think. I enjoyed it.
Yeah, can't wait to see how this plays out, and let's discuss it if we get further development again. All right, let's wrap it up there today. Thank you, Andrei and David, and thanks for everyone for listening. Stay safe out there. Watch out for wrenches. Buy Bitcoin. See you later.